Hi, everybody. My name is Stephen White, and welcome to the PayTaxOnce.com channel, home of the Pay Tax Once Nation. Today, I'm going to talk about a question that I often receive from new and existing clients. And that question is, Stephen, how much money would I need to have in another investment account, for example, a tax-deferred account, so an IRA or a 401k? How much money would I need to have in that account to deliver the same amount of money after tax that I can get from my Pay Tax Once contract? Great question. I love it. Today we're going to address that, and what I'm about to show you is going to absolutely blow you away. And it's going to shed light on a quote that I once heard from a gentleman years ago that says, where your money lives is far more important than what it returns. So let's dive in. I'm first going to give you the parameters here. We're going to set this up with an annual contribution of $100,000 a year. Again, the Pay Tax Once strategy is for high-achieving S-Corp and C-Corp owners and entrepreneurs. You ladies and gentlemen are knocking the ball out of the park. You're above average in income, and you don't have an income problem anymore. You have a tax problem. So we're going to help you solve that big tax problem, at least this after-tax problem. So again, let's start off with $100,000 going in for the next 10 years into the limited pay whole life contract that is associated with the mutual insurance carrier. We're going to use a tax-deferred investment, IRA, 401k. We're going to use a tax rate of about 20%. I think that's fair. I tried once to have my CPA type up a letter on his letterhead, date, and sign it, guaranteeing me that I would retire in a lower tax bracket. I'm still waiting on that letter, but let's just use 20% tax rate for today's conversation. So again, what we're solving for is income every year after taxes. We're going to use a safe withdrawal rate of 3.5%. If you Google, do a search for safe withdrawal rates from retirement investments, you're going to see anywhere from 2.8 to 4%. And what that is, it's the percentage of money you can remove from your investment that will give you a 93 to a 97% chance of not running out of money before you kick. That's a 93 or a 97% chance of not running out of money. So we're going to meet that in the middle and use a 3.5% withdrawal rate. We're going to compare it to our limited pay cash value contract. The cash value is the asset. The other asset is your money growing inside through dividends and interest. And then you have this death benefit. Now, the money inside these cash value contracts, the money does compound year after year. Unlike our market-based investment, our market-based investments don't compound. The market moves up and down. It's a growth line, not a compound curve. And there is a huge difference between the two. All righty, let's move on. We're going to take $65,000 a year. That is the average that comes out of these contracts. And the reason I say average is there's probably 3, 4, maybe 5 mutual insurance carriers that have the right product to deliver this strategy in a way that doesn't fail. We're going to use policy loans to drive the cash flow. Policy loans are one of 2 or 3 different ways that we can remove the money or use the money inside these contracts. This little square up here in the top, that's your IOU on your death benefit. So yes, in this case, we are spending down our death benefit while we're still alive. What a concept. I love it. To give you an example, again, we're using $65,000 a year. I just finished up a case. A couple, they're putting in $100,000 a year into their contract. And when we turn their income on at age 65 through 85, their cash flow was $85,500 and change. But for today, again, we're going to use $65,000. So the capital equivalent value, again, we're going to take 65 out of our qualified account using the 3.5% safe withdrawal rate. Again, that's your Monte Carlo simulation calculator or your Trinity study calculator. Do a internet search on those, and you'll find all kinds of great information on that simulation. We're going to use the capital equivalent value of this. So how you do that is just take your annual withdrawal and divide it by your safe withdrawal rate, grossed up for taxes. So the capital equivalent value is $2,321,000 and change. So again, over here we have 1.1 million in our cash value. That's kicking out $65,000 a year. Here we need 2.3 million, folks. That's more than twice. That's crazy. But we got one other issue we're dealing with. And again, here's the time money value, the time value of money calculator. Can you tell I get excited when I talk about this? Anyway, it's $100,000 a year, 10 years, the annual interest rate 14.9% to get to 2.3 million to deliver $65,000 a year. The rate of return, here's the kicker. The rate of return that you would need to realize every year, 10 years in a row, is 14.9%. 14.9% every year for 10 years in a row. I don't know about you, but I've looked at the history of the stock market and I've never seen 10 years in a row of 14.9%. I've not even seen an average, let alone an actual. This is an actual rate of return that you would need. Crazy. But again, we got one more kicker. We have this thing called Social Security income. The average couple today, $40,000, $45,000 a year when you combine their Social Security. Again, that's average. Yours might be lower, might be higher. But our Social Security income is roughly $40,000 a year. But because we pulled out $65,000 out of our qualified account, we've triggered the taxes on our Social Security. So now we need another $8,000 to cover the Social Security taxes on our Social Security benefits. Yes, up to 85% of your Social Security benefits can be taxed if you exceed the threshold. Is that not a tax on a tax? Yes, that is a tax on a tax. I don't want to go down that path, but we all know that that's just crazy, crazy, crazy. So we now actually need $73,000 coming out of that qualified account to net our $65,000 and pay the taxes on our Social Security. Thank God we used 3.5% safe withdrawal rate, because we need a little extra, don't we? We don't want to run out of money there, do we? Next piece, the capital equivalent value of $73,000. Divide that by your 3.5%. It gets worse. We need $2.6 million in this tax-deferred investment using a safe withdrawal rate of 3.5% to give us $65,000 a year and $8,000 to cover the tax on our Social Security. The rate of return, again, 16.91. I have never, ever seen in the history of the stock market 16.91% return actual every single year, 10 years in a row. So again, less is more. 1 million is less than 2.6. And you're getting more money because you don't have to grab another $8,000 to pay taxes on your Social Security if this is your only source of income. So how can we apply this to your wealth strategy? Well, a couple points I'd like to make is it's not about how big of a pile you have. Again, it's not about how big of a pile you've accumulated. It's how much of it can you spend? How much of it's yours? Our qualified accounts, we're simply beneficiaries. We're not even owners of those accounts. But again, how much of it can you spend? Secondly, a focus on spendable retirement income, your acquisition costs, and the benefits might be way more valuable than comparing it to rate of return alone. Again, where your money lives is far more important than what it earns. A third point, when you properly craft the right strategy for you in a cash value life insurance policy, again, limited pay, we're not dealing with the life pay contracts, limited pay contracts. 10 years, 15 years, maybe 20 years is all you need as far as a time to fund those contracts. You're done. You're done after 10, you're done after 15, or whatever that number is. You're done. And yet you get mailbox money in the form of dividends every single year. And those dividends are pretty nice. But again, the cash value can not only provide you with the death benefit, you croak early, your spouse is taken care of. Your spouse now has a bunch of tax-exempt cash flow that they just received for their benefit, and the cash value in your contract. Your spouse can do whatever he or she wants to do with that money. But again, it compares extremely favorable to a qualified account. In qualified accounts, once both parents are gone or both mom and dad are gone, the kids or whoever that receives that qualified account, now they have to spend down or realize that income over a 10-year period. That's another video. I'll do another video on that. Bear with me. That one will drive you back crazy. The last point I want to make is many of your retirement benefits are affected by income-based assessments. Income-based, capital gain-based. Capital gains taxes can trigger up to 50% of your Social Security benefits being taxed. Income can trigger up to 85% of your Social Security benefit being taxed. So again, take all that in consideration. But again, if you're an independent thinker, if you don't believe in traditional or conventional planning, you're not really keen on trusting Wall Street or the government, this is a great strategy for you to take a look at and for you to add to your repertoire of your retirement income. So that's all I have for you today. I hope you learned something. If you did learn something, click on the links below. There's a link that leads you to an ebook that I've produced. It also there's another link there for it's about 10 minutes, maybe 12-minute long a webinar that goes into the details, and I actually give you some case studies on this strategy, some real live case studies. So again, I hope you enjoyed it. Again, do subscribe to the YouTube channel if you feel this is valuable for you. I will be releasing content on a weekly basis. And again, thank you for your time today. Have a wonderful evening.